Alright, you should have completed your homework for Chapter 2, and we're starting on Chapter 3, the income statement. If I had to tell you which financial statement is going to be most important to you as an entry-level manager or an operations manager when you graduate, it's going to be the income statement. This is the financial statement that your bonuses are going to be based on, and I assure you that if your bonus is based on this statement, you're going to become an expert at it. Whenever money's a factor, we seem to have a little bit more motivation. So what we have is 4 categories on an income statement, main categories. We have revenues, which are sales. We have expenses, which as the book defines it, an outflow of assets or an increase of liabilities. Basically, expenses are going to be deducted from revenues, and mostly everything that we have on an income statement is either a revenue or an expense. And then we have gains and losses. The difference between a revenue and a gain and an expense and a loss is that revenues and expenses are from our primary focus of business, and gains and losses are when we go ahead and basically sell assets that are not part of our primary core business. And an example would be if we're a pizzeria and we go ahead and we sell a delivery van and we make money on it. That's going to be a gain. It's not revenue because we're not in the car selling business, and if we sell that same van and we lose money on it, it's going to be a loss. We want to separate gains and losses from revenues and expenses, so when we compare our financial statements year over year, we know what's coming from our core business and what's coming from those limited sales of assets, or from time to time. If we were to look at an income statement for a multi-unit department, I would give you an example as a hotel where you've got rooms and you've got food and beverage possibly you have like a gift shop, or even some resorts rent out chairs, and then we have the telephone, which is often a profit center for hotels. So those would be different departments. So we would have departmental income, hopefully. After we have departmental revenue, departmental expenses, we should have departmental income. It's also called contribution margin. And if you were a departmental manager, that's the number you would be bonused on. So if you were the restaurant manager, you would be bonused on the food and beverage portion of the income statement, or P&L is what it's commonly called, profit and loss statement. And anything below that you wouldn't be managing, so it shouldn't affect your bonus. Those items that we can't assign to a department, those expenses that we can't assign to a specific department, are going to go under undistributed operating expenses. That's also called UOE. Undistributed operating expenses are things like the general manager and administration, marketing for the for the property, maintenance, utilities. If we tried to allocate those expenses to the department, as an example, we use square footage as a basis of utilities. We're going to get ourselves in trouble. And the example I always use is a casino resort. If we were to look at a casino resort and we were to allocate those expenses on a square foot basis, we may find that our restaurants aren't making nearly as much money as our casino floor, and we could make the decision to remove our restaurants and put gaming in the restaurants. Well, now we've taken away an amenity to our guests, and our revenues are going to close. And if we further looked at the property and we decided that rooms wasn't making nearly as much money as the casino floor, we could knock out the rooms, and before you know it, we just have a casino and we have no way to keep those guests there, and we're going to get in trouble. The next line is management fees. Management fees are when we have a company manage our operation. A lot of hotels are managed, well, as an example, Marriott only owns about 3% of its properties. The rest of them are properties that they manage. So they may not own the property, but they manage the properties. And they get paid in the form of management fees. So once we've taken our departmental income, we subtracted our undistributed operating expenses and our management fees, we have income before fixed charges. Fixed charges are fixed costs. Usually they have to do with PP&E, plant, property, equipment. So fixed charges could include things like mortgage or rent, depreciation, interest, things like that. After we subtract out our fixed charges, we have net operating income. And going back a step, if you're a general manager, you're going to be bonused on the income before fixed charges because you cannot manage fixed costs. So as a departmental manager, you're going to be bonused on the total departmental income. As a general manager, you'll be bonused on income before fixed charges. After fixed charges, of course, we have normal operating income, and then we subtract out replacement reserves. I wouldn't worry about that so much. And then we have adjusted net operating income or net income. So hopefully after we go ahead and take our sales or our revenues and we subtract all of our expenses, we have a net income and not a net loss. What we don't have on here is the taxes, and the taxes are actually going to fall below replacement reserves. Now this should be a review for you all as far as calculating cost of sales. Hotel rooms don't have cost of sales, but food and beverage both have cost of sales, and so may other departments. So what we do is we take beginning inventory and we add our purchases for the period, and then we subtract out our ending inventory, and that gives us the cost of goods consumed or used. And then we add or subtract out transfers, and that gives us cost of goods sold. So if you look at the bottom of this slide, you've got the formula that we use: B plus P minus E equals cost of goods consumed or used, as I said. And then we add and or subtract out transfers for cost of goods sold. Transfers for a food department, maybe that we, as an example, we might buy lemons for the bar. And when those lemons come in, we go ahead and transfer that case of lemons to the bar, so the bar gets expense for those and the restaurant doesn't. Another example that I did every day when I ran a full-service restaurant, I supplied a meal to my staff. So if you were working that day, you come in at 4 o'clock and you could have a meal on me. And I went ahead and transferred those costs to employee benefits. If we're doing marketing and we're preparing food, we'd want to go ahead and transfer those costs to marketing, as an example. Alright, so if we look at different operating departments, I mentioned some of these to you. I mentioned rooms, food, beverage, telecommunications. Rentals would be if we were renting lounge chairs at the swimming pool, or maybe we had a golf course and we were renting out club. Well, I guess we have golf course and pro shops, so that would be different. But we could be renting out, I don't know, a number of items. I can't think of any right now. Maybe you guys, it comes to mind to you. And then we could have a spa, and we could even have parking or valet where we have another operating department. And that could even grow to retail and such. So those are just examples. We talked about undistributed operating expenses, UOE. Again, those are expenses that we can manage, but we can't allocate to specific departments. And I've already gone over these. Administrative in general is going to be the general manager, or maybe an administrative assistant. Could even possibly be human resources in there. Sales and marketing. POM, or property operations and maintenance, that's just maintenance. And then utility costs. Some people believe that utility costs are a fixed cost, but I think all of you know that you can turn up or down your AC, turn on and off lights, and reduce your electric bill at home. If you can do it at home, you can do it in a business. Again, fixed charges excuse me, are fixed costs, and they usually relate to PP&E. So we've got rent, property taxes, insurance, depreciation, amortization, and interest. The difference between depreciation and amortization, just so you know, you're not going to be tested on this, is depreciation is what we do to physical assets, and amortization is what we do to, let's call them theoretical assets. So if we have a franchise fee that we had to pay and we're amortizing it over a period of time, or maybe we buy goodwill, which is like the name of a restaurant. Maybe we Outback used to have a large goodwill of their name because the Outback brand was so large, and they would go ahead and depreciate that over time. Sometimes we buy a brand and then we write it off over a period of time. We do that through amortization. Okay, so now you have your homework for chapter 3.